Imagine making millions, no billions, by betting against the market, manipulating trades, and using strategies so complex that even Wall Street struggles to keep up. Hedge funds are some of the most secretive and powerful financial institutions in the world. But how do they actually make money? And why do some hedge fund managers end up richer than entire countries while others go completely bankrupt? Let's break it all down. What are hedge funds? In simple terms, a hedge fund is an investment vehicle that pools money from wealthy individuals and institutions and then invests it in various assets. But unlike traditional mutual funds, hedge funds play by different rules or sometimes by no rules at all. While regular investors are happy to earn a steady 7 to 10% return per year, hedge funds aim for massive gains in any market condition, bull or bear. Their whole job is to make money no matter what. And to do that, they use some of the most aggressive, high-risk strategies in finance. But before we get into how they actually make money, let's talk about what makes hedge funds different. Hedge funds aren't like your regular investment funds. They operate with fewer restrictions, more risk, and way higher rewards, at least for the fund managers. Here's what sets them apart. Unlike mutual funds, hedge funds aren't open to the public. To invest, you typically need to be an accredited investor, meaning you have a net worth of at least $1 million or an annual income over $200,000. In other words, hedge funds aren't for regular people, they're playgrounds for the ultra-rich. Hedge funds operate with far fewer rules than mutual funds. They don't have to disclose their trades in real time, meaning they can make huge market moves in the shadows. The only time the public gets a glimpse? When they file their 13F reports, which only happens once a quarter. Hedge funds can do things that traditional funds simply aren't allowed to. They use short selling, betting on stocks to go down instead of up. Leverage, borrowing billions to make even riskier bets. Derivatives, complex financial products that can multiply profits or wipe out billions overnight. Algorithmic trading, AI-powered systems making millions of trades per second. And because they claim to never lose money, they charge insane fees, 2% of all assets under management, plus 20% of profits. That means even if a hedge fund loses money, the managers still get paid. But how do these funds actually make money, often when everyone else is losing? Let's break down the trading strategies that fuel the world's most powerful hedge funds. Now that we know hedge funds have fewer rules, higher risks, and insane fees, let's break down their secret money-making strategies. These are the tactics that let them profit in bull and bear markets, sometimes even when the entire economy is crashing. Most investors buy stocks hoping they go up. Hedge funds? They bet both ways. Long positions, buying stocks they expect to rise. Short positions, betting against stocks they think will drop. Example. If a hedge fund buys Tesla, TSLA, but shorts Ford, F, they're betting Tesla will outperform Ford. Even if the entire auto industry drops, as long as Tesla falls less than Ford, they still make money. Global macro strategy. Betting on entire economies. Some hedge funds don't just invest in stocks. They place massive bets on entire countries' currencies, betting the US dollar will rise while the Japanese yen falls. Commodities, investing in oil, gold, or even wheat, based on global events. Interest rates, predicting central banks will raise or cut rates. Legendary hedge fund manager George Soros made $1 billion in a single day by shorting the British pound in 1992. Hedge funds don't just react to markets. They move them. Arbitrage, risk-free profits. If done right, hedge funds love exploiting tiny price differences in markets. This is called arbitrage, and it comes in different forms. Merger arbitrage. If Apple announces it's buying a company for $100 per share, but the stock trades at $95, hedge funds buy the stock, betting the deal will close. Statistical arbitrage, using AI and algorithms to find tiny price inefficiencies and execute trades in milliseconds. Point 4. High-frequency trading, beating the market by milliseconds. Some hedge funds use supercomputers to execute millions of trades per second. By the time a regular investor hits buy on their app, these funds have already made money by front-running orders, taking advantage of tiny price moves before anyone else can react. So what's the catch? While hedge funds sound invincible, they're not. Many of them blow up spectacularly when their high-risk bets fail. The 2008 financial crisis wiped out several, and even some of the biggest funds today have seen billions in losses in just months. But the real question is, how do hedge fund managers always get paid, even when investors lose money? Hedge funds don't just make money from winning trades, they make money from you. Even if a fund loses billions, the managers still walk away with fat paychecks. How? The 2 and 20 rule, the ultimate money machine. Most hedge funds use a 2 and 20 fee structure, meaning 2% management fee. They take 2% of all assets under management every year, no matter what. Even if they lose money, 20% performance fee. If they make profits, they take 20% of the gains. Example, if a hedge fund manages $10 billion, they automatically make $200 million a year in management fees just for existing. If they make $1 billion in profits, they take $200 million of that too. Even in a bad year, hedge fund managers still cash in. But when they win big, they make generational wealth. Locking up your money, the golden handcuffs. Unlike a regular stock portfolio where you can buy and sell anytime, hedge funds lock up investor money for years. Lockup periods, you might not be able to withdraw your investment for 1 to 3 years. Redemption restrictions, even after the lockup, some funds only let you withdraw quarterly or even once a year. This means hedge funds can keep collecting fees, even if investors want to leave after. Terrible losses. Leverage, making big bets with borrowed money. Hedge funds don't just use investor money, they borrow billions to amplify their bets. If a fund has $10 billion, they might borrow another $40 billion and invest $50 billion total. If things go right, they make insane profits. If things go wrong, investors get wiped out, but the hedge fund already collected their fees. This is why hedge funds can be dangerous. Some of the biggest financial collapses in history happened because hedge funds over-leveraged and blew up. Side hustles, how hedge fund managers make even more money even if their fund performs terribly. Hedge fund managers still launch new funds under different names, charge consulting fees to billionaires, banks, and governments, write books, give speeches, and sell their expertise. They're masters of branding, turning even failures into money-making opportunities. The bottom line, the game is rigged in their favor. Hedge fund investors take all the risks. Hedge fund managers get rich no matter what. Some hedge funds dominate, but most underperform the S&P 500. And yet, billionaires, celebrities, and even pension funds still pour money into them. But why? That's what we'll expose next. Who really benefits from hedge funds, and why do the rich keep investing in them? Why the rich keep pouring money into hedge funds even when they underperform. By now, you might be wondering, if hedge funds are so risky and expensive, why do the ultra-rich keep investing in them? It turns out it's not just about making money. It's about power, secrecy, and control. Exclusive access. The Billionaires Club. Hedge funds aren't for everyone. You need to be an accredited investor, meaning a net worth of at least $1 million, excluding your home, or an income of $200,000 plus per year, $300,000 for couples. This creates a sense of exclusivity. The idea that hedge funds give you access to elite investment opportunities that the average person can't touch. For the wealthy, it's not just about returns. It's about status. Tax loopholes, pay less. Keep more. Hedge fund managers and investors use legal tricks to pay way less in taxes than the average person. Carried interest loophole. Hedge fund managers' earnings are taxed as capital gains, 15 to 20%, instead of income, 37%. Offshore accounts. Many hedge funds are based in tax havens like Cayman Islands to avoid regulations and taxes. Deferred tax benefits. Some hedge fund investors delay paying taxes for years, letting their wealth compound tax-free. For the ultra-rich, hedge funds aren't just an investment, they're a tax shelter. Influence and power, buying their way into the system. Many hedge fund managers become some of the most powerful people in finance and politics. They donate millions to political campaigns to influence tax laws. They lobby for deregulation to make their trades riskier, but profitable. Some even get government bailouts when their bets go wrong. Looking at you, 2008. For the wealthy, hedge funds aren't just about making money. They're about protecting and growing their influence over the financial system itself. The hedge fund illusion, selling the dream despite underperforming the S&P 500 on average. Hedge funds sell the illusion of genius. They use complex strategies that sound too advanced for the average investor. They show off high-profile wins while downplaying their losses. They get media coverage, making them seem like investment gods. This keeps the money flowing in, even when most investors would be better off in a low-cost index fund. Final thoughts, the hedge fund game is rigged, but can you still win? Hedge funds are designed to make their managers rich, even in bad years. The ultra-wealthy use them for power, secrecy, and tax benefits. Most people would be better off investing in a simple S&P 500 index fund. So the question is, would you ever invest in a hedge fund? Or do you think they're just a rich person scam? Let me know in the comments. And if you want more breakdowns like this, hit that like button, subscribe, and turn on notifications, because we're just getting started. Subscribe for more money,